Is a second wave of inflation about to strike? Join us as we delve into historical parallels, urgent economic indicators, and Federal Reserve moves that could reshape your financial future. Our experts dissect potential market rallies and impending drops, offering crucial strategies for navigating these turbulent times. Will inflation surge again, or are we heading for a market boom? Don't miss out on these critical insights. Like and subscribe for more. Today, on Financial Analysis in Review, we will summarize the following videos. From Game of Trades, we have a once-in-a-lifetime financial event is here. From Figuring Out Money, we have This is going to be explosive. From Figuring Out Money, we have live trading, crypto crash, small caps coil, mega caps fly, gamma levels, and expected moves. From Eurodollar University, we have Europe is now in full-blown crisis mode. What does this mean for the rest of the world? From ClearValue Tax, we have Fed's interest rate decision, what you can expect in 2024. From Bob Elliott, we have Why is the Fed in a do-nothing mode in July 2024? Welcome back to Game of Trades. Today, we dive deep into a topic that's buzzing louder than a beehive during pollen season, inflation waves and their ripple effects on the stock market. The core thesis of this video is to investigate the signs of a potential second wave of inflation, akin to the catastrophic inflation waves of the 1970s, and what it means for the stock market going forward. By examining economic indicators and expert opinions, the goal is to determine whether we might face another dramatic financial event and how investors should prepare for it. Here are the key points discussed by Game of Trades' historical context. In the 1970s, three massive inflation waves devastated the U.S. stock market, causing a total decline of 70% over a decade. Fast forward to today, we've just experienced the biggest inflation surge since then, with the market dropping 25% in 2022. Current inflation metrics. Larry Summers warns of a possible second wave of inflation due to high government spending. Super core inflation showed a 5% increase over 3 months in early 2024, indicating potential inflation pressures. Economic indicators. While food and gasoline prices have stabilized, any upward trend in these essentials could reignite inflation pressures. The stock market's movements are closely tied to Federal Reserve actions, particularly interest rate decisions. Federal Reserve's impact. The Fed's stance on interest rates has significantly impacted the market. Rate hike talks tend to drive the market down, while rate cut discussions propel it up. Current low levels of core inflation may lead the Fed to cut rates more aggressively, potentially pushing the market higher. Game of Trades made the following predictions. Possibility of a second inflation wave. If food and energy prices start rising again, it could trigger another inflation wave, similar to the 1970s. The evidence is mixed, with some metrics showing stabilization, while others suggest potential for renewed inflation. Stock market rally. Despite concerns, there is a perspective that the equal-weighted S&P 500 RSP could catch up to the S&P 500, leading to another market rally. This would be driven by a potential reduction in interest rates if the Fed sees continued low inflation. The video wraps up by underscoring the importance of paying attention to both historical patterns and current economic indicators. While there are risks of another inflation wave, there's also potential for a market rally if the Fed cuts interest rates. Investors are encouraged to stay informed and take advantage of Game of Trades insights to navigate these turbulent waters. Good evening, ladies and gents. Welcome to another electrifying episode of the Stock Market Brief Show on Figuring Out Money. Your trusty guide through the wild financial markets is none other than Michael Silva. Today, we'll dive into some really tight market charts that are as ready to explode as popcorn in a microwave. Hold on to your hats as we navigate the choppy waters of technical and intermarket analysis. Let's get this show on the road. Today's core thesis is a deep dive into the current tight market conditions and the explosive moves that could follow. Michael Silva examines the intricate dance between rate cuts, inflation data, and historical market patterns to predict whether we're in for a thrilling rally or a nail-biting drop. Here are the key points discussed by Michael Silva. Rate Cut Watch. Michael uses the CME FedWatch tool to reveal the market is anticipating a rate cut in September. Upcoming events could shake things up. Jerome Powell testifies tomorrow, and again on Wednesday. Yellen speaks tomorrow, and we get core inflation and PPI data by Friday. It's like a data fireworks show waiting to happen. Historical market patterns. Michael highlights that market volatility often spikes when transitioning from rate hikes to rate cuts. Analyzing the iShares Russell 2000 ETF, IWM, Silva reveals that the best time to buy small caps is when the federal funds rate is low. Bollinger Bands and market moves. The tightness of Bollinger Bands on the IWM suggests an imminent explosive move, either up or down. It's tighter than your pants after Thanksgiving dinner. Historical parallels like 2020 and 2018 indicate potential for big expansions. Bullish percent index and divergences. Silva examines the bullish percent index, showing market breadth might be improving and potentially leading to stronger performances from smaller cap stocks. Positive divergences spotted in the New York Stock Exchange bullish percent index suggest a change in trend could be coming. Growth versus value. Growth stocks are outperforming value stocks, but a divergence in relative strength hints at a potential rotation. Michael Silva made the following predictions: explosive market moves. Michael predicts significant market moves based on the tightness of Bollinger Bands. The direction is uncertain, but the volatility expansion is expected soon. Could this be Wall Street's next big thriller? Shift in growth and value. Expect potential pullbacks in growth stocks, while value stocks might see some love in the near future. To wrap up, Michael emphasizes the need for tactical trading in these tight market conditions. It's crucial to manage risk, take profits, and stay alert for both upward and downward moves. He hints at opportunities in mid-cap and utility stocks, but reminds viewers to be ready for anything, because when it comes to the stock market, it's all about expecting the unexpected. Stay sharp, manage your risks, and keep reading those charts. Welcome to Figuring Out Money. Today, Michael Silva is diving into a lively and action-packed live trading session. The spotlight is on a range of hot topics: crypto's dramatic crash, the intriguing movement of small caps, and the meteoric rise and fall of mega caps. Buckle up, because we've got gamma levels and expected moves to talk about as well. Michael, with his unique perspective and knack for analyzing complex market trends, has plenty to share. Today's video centers on navigating the tumultuous week ahead, with Fed Chair Powell's testimony, inflation data coming up, core PPI data on Friday, and their collective impact on the market landscape. The focus is on understanding market-implied volatility, sector leaders like NVIDIA, and the S&P 500's pivotal levels, with an eye towards strategic trading during a week loaded with catalysts. Here are the key points discussed by none. Michael Silva is flying solo. Upcoming key events. Fed Chair Powell's testimony over 2 days is anticipated to provide significant direction. Core inflation data scheduled for Thursday, with PPI data following on Friday, are critical data points. Market movements and sector leaders. NVIDIA is leading the market with significant weight. Intel and Apple are also notably moving. Mega caps like Meta and Microsoft are seeing consolidation after big moves, which is not surprising. S&P 500 key levels. Michael identifies the crucial trading range for the S&P 500 around 5,600, noting market efforts to reach higher but facing consolidation at 55,575 and 55,50 levels. Market dynamics in positive gamma territory encourage buying on dips and selling into strength, suppressing volatility. None. Michael Silva is flying solo. Made the following predictions: market's response to Monday data. Anticipation of the market reacting to macro data with fluctuations in implied volatility. The possibility of a wild week driven by traders' responses to incoming information and rate cut expectations. Tech sector trends. Continued leadership from tech giants like NVIDIA is expected. However, consolidation periods will likely occur after significant runs, affecting the broader market. Michael underscores the importance of strategic trading in a week fraught with macroeconomic data and influential testimonies. He advises paying close attention to market reactions to Fed announcements and upcoming data releases. His call to action emphasizes staying informed, being patient, and managing risks wisely as we navigate potential market volatility. Welcome back to Eurodollar University. Hosted by the insightful Jeff Snyder, today we dive into a critical analysis of Europe's current state of crisis and its potential ripple effects across the globe. Buckle up, because Jeff's about to break down the economic turmoil, political unrest, and a whole lot more, with his signature clarity and depth. The central thesis of the video is that Europe is entrenched in a full-blown economic and political crisis that is not only failing to improve but is likely to worsen. This crisis, propelled by macroeconomic failures and broken promises of disinflation, is contributing to rising unemployment and voter unrest. Moreover, the repercussions of Europe's struggles are expected to spill over globally, exacerbating economic instability worldwide. Here are the key points discussed by Jeff Snyder. Political and economic turmoil in Europe. European voters are increasingly frustrated due to stagnant or worsening economic conditions, as seen in countries like France, Germany, and the UK, with high percentages of people rating their economies as bad. Incumbent governments are being ousted in elections as citizens express their discontent through the ballot box. Disinflation and economic mismanagement authorities promised disinflation would bring prices back down, but instead, prices surged and have stayed higher. Voters feel betrayed as they see no improvements in their purchasing power, despite enduring economic stagnation and recession-like conditions. Deteriorating economic indicators. Retail sales across Europe are abysmal, showing only temporary and negligible improvements, indicating deepening recession. German economic indicators are particularly grim, with factory orders and industrial production plummeting to their lowest in years. International trade is faltering, contributing to declining demand for German goods from outside Europe. Global implications. Worldwide economic indicators, like those from the World Trade Organization and the UN, show minimal growth, with trade volumes at their lowest in decades outside of global recessions. With private savings from the pandemic depleted, any remaining economic activity is increasingly reliant on debt, a precarious situation given tightening credit conditions. Jeff Snyder made the following predictions. Global synchronized recession. Jeff predicts that 2024 will not see the expected economic recovery. Instead, the global economy may synchronize into a recession due to compounding negative factors such as rising unemployment, stagnant trade, and deteriorating economic conditions across key regions like Europe, the US, and China. Continued voter unrest and political instability. As economic conditions fail to improve, political upheaval driven by widespread voter dissatisfaction is expected to persist, not just in Europe, but globally. Jeff Snyder concludes that Europe's economic crisis is a bellwether for impending global economic turmoil. The failure of disinflation policies, rising unemployment, and deteriorating trade are creating a perfect storm that may lead the world into a synchronized recession in 2024. Voters' mounting frustration, their push for political change, and the shift from public savings to debt reliance signal that we are in for a turbulent ride. To all viewers, stay informed, stay prepared, and maybe consider subscribing to Eurodollar University's in-depth content to navigate these choppy waters. Welcome back to ClearValue Tax. Today, Brian Kim takes us on a whirlwind tour through the maze of Fed interest rates and forecasts for 2024. Buckle up as we dissect Jerome Powell's latest comments from the ECB forum and why everyone is holding their breath for September. The essence of today's video centers on the Fed's cautious approach to interest rate cuts. Despite the nearly reaching their 2% inflation target, they're not quite convinced to start the cutbacks just yet. Strap in as we dive deep into why Jerome Powell and the Fed are playing it safe and what this means for the economy moving forward. Here are the key points discussed by Brian Kim, Fed's current stance. Powell emphasizes needing more data before cutting rates, despite recent 2.6% inflation. Close but not cigar, folks. Powell stresses that the labor market needs to remain robust to support any rate cuts. They're well aware of two-sided risks: react too soon and undo progress, delay too long, and risk economic damage. Meeting dates and odds. Next Fed meetings, July 31st and September 18th. The July 31st meeting? Don't hold your breath. Only a 6.7% chance of rate cuts. September 18th looks more promising, with a 77.6% chance for a rate cut. Pencil that date in, but keep the eraser handy. Labor market performance. June jobs report. 206,000 jobs added, but with a few caveats. Prior months revised down by 111,000 jobs. Wage growth is up 3.9% year over year, but unemployment slightly up and time to find a job has increased. Federal Reserve minutes. Fed minutes from July 3rd back up Powell's cautious tone. They're in no rush to cut rates, ready to respond to any unexpected economic downturns, be it GDP drops, stock market crashes, or housing market woes. Brian Kim made the following predictions: September rate cut. High odds of rate cuts in September. If data supports further economic stability, this could be the turning point, but keep an eye on labor and inflation reports. Impact of upcoming data. June CPI report due on July 11th, critical for influencing September's decision. Keep tracking those monthly reports for signs of economic weakness that may prompt earlier intervention. Brian Kim concludes that the Fed remains on a cautious path, prioritizing detailed economic data before making any big moves. The suspense isn't just killer, it's strategic. He urges viewers to stay updated, particularly with key dates like July 11th and September 18th, and reiterates the importance of paying attention to ongoing monthly reports. Hey everyone, welcome back to the Bob Elliott channel. Today's hot topic? Just the Federal Reserve's latest do-nothing attitude towards the U.S. economy and inflation. And guess what? Our insightful host, Bob Elliott, is here to deep dive into why the Fed is just practicing the fine art of doing zilch. Bob's central thesis in this video revolves around the Federal Reserve's current do-nothing policy stance. With inflation slightly above target and an economy that's slowing but still tight, the Fed's inaction seems pretty logical, according to him. Bob says the Fed's just meditating in the calm before any potential storm forces them into action. Here are the key points discussed by Bob Elliott, Fed's inaction and market expectations. Bob emphasizes that the Fed has been sitting on its hands for the past 6 months. They did nothing in the latter half of last year, too. Absolutely nada. Markets expected 7 rate cuts at the start of the year. Crazy, right? Now they're down to expecting just 1 cut. Bob calls that ridiculous flexibility. Inflation pressures. Bob explains that inflation is slightly above the Fed's mandate, but says there's no sign it will shoot up soon unless there's a big oil price shock. Talk about needing a miracle. Housing, shelter, and motor vehicle insurance are the major inflation culprits, making up about 65% of total inflation. Employment dynamics. Unemployment is at 4%, low by historical standards, but slowly ticking up. Bob points out that the Fed usually cuts rates because of rising unemployment, not just inflation. Bob adds that the rise in unemployment is more supply-driven, thanks to more people entering the job market, including increased immigration and prime-age labor force participation. Fed's perspective on labor market. Bob thinks the current modest loosening of the labor market is actually what the Fed wants: high participation and low firings, making it an optimal situation. Bob Elliott made the following predictions: moderate tightening of labor market. Bob predicts the unemployment rate is going to inch up a bit, but not in a scary, dramatic fashion. A fine balance is what he foresees. Minimal policy shifts. According to Bob, unless we see a significant change in inflation or economic slowdown, the Fed will likely keep being the serene Zen master of do-nothing policy. Bob ties everything up by highlighting that the Fed's current do-nothing policy is a calculated, not lazy move. He's betting the Fed will stay this course unless something drastic happens. So, sit tight and enjoy the show as the Fed stays in its Zen mode. Keep your eyes on inflation, job dynamics, and potential policy changes. And, of course, don't forget to like, subscribe, and hit that notification bell for more insightful content. Our experts offer diverse perspectives on the current financial landscape. Game of Trades anticipates another potential inflation wave akin to the 1970s and a possible market rally driven by rate cuts. Michael Silva predicts imminent market volatility with significant moves influenced by upcoming economic data. Jeff Snyder warns of Europe's worsening economic crisis, triggering global recession, while Brian Kim and Bob Elliott highlight the Federal Reserve's cautious stance, waiting for more data before cutting rates, each with their own take on market dynamics. Overall, they all agree on the need for strategic trading and staying informed in these uncertain times. Thanks for watching Financial Analysis in Review for July 9th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.